Hi, and welcome to our ATAD 3 webinar. This is the first technical webinar organized by our very active tax committee. And as we can see, we wanted to thank you, dear attendees, for your presence today. Huge interest, but also lots of discussion, and the protection of our industry and of our members is, as usual, core for the LPA. So that's why I will quickly pass over to Giuliano, who will be the moderator of today's session, and he's also the co-chair of our tax committee. What's actually on the menu, that's what you will discover with the team. So first of all, the proposed regime, but also the scope. Afterwards, you will hear about the gateway criteria and certainly the reporting standards. And if that would happen now, the let's say tax consequences you could expect, which is not so positive. So let's see and have a look at all that. As usual, this is an interactive session, so don't hesitate to ask your questions via the chat function or the Q&A button. And now, without further ado, I will pass over to Giuliano.
Thank you, Stefan, and good afternoon, everyone. So this is the first webinar on ATAD 3 organized by the LPA. So as you know, it's a kind of Christmas gift that the EU has given us, or at least the EU, to every EU member state. Today, the panel is composed by the following: is Anne-Cécile Jourdan from ATAD Group, Alina McAvoy from PwC, Oliver Ho from Atos, Olivier Dalfara from Baker McKenzie, Danny Taillon from Deloitte, and last but not least, Jean-Baptiste William from Augier. As you see, a lot of people that will share with us their view and concern about the ATAD trio. So as I already mentioned, it is a Christmas gift that the EU has given us with this kind of directive. Jean-Baptiste, can you give us an overview of the background of ATAD trio? And really, do you believe that the directive will be implemented as it is without any amendments, or will there be something it can be changed? What is your view on that?
Thank you, Giuliano, and thank you to all the fellow panelists for this participation, and thank you for the people attending this conference. Indeed, that's a very good question to wonder, actually, where does this come from and where we will go in the next few weeks or months. First, we can say that this ATAD 3 directive does not derive directly from any BEPS action per se, so contrary to what we had with ATAD 2 and ATAD 1, for example, or DAXIS. So it's really a work from the European Commission, which actually was already discussed by the European Commission in May 2021, when was released the Communication of Business Taxation for the 21st Century. So along some of the measures that were discussed by the European Commission as a plan for a fairer and a more transparent tax regime in Europe, was the question of this misuse of shell entities. There was, of course, that derived actually from some media leaks, the Pandora Papers, for example, or some public scrutiny. There was also an initial work conducted by the European Parliament in 2018 on the misuse of shell entities in the EU. So this would be for the background. So in June 2021, the European Commission started some public consultations to get feedback from the industry and from stakeholders. The European Commission received approximately 50 contributions from NGOs and professionals. And a lot of feedbacks actually insisted on the fact that the use of shell entities cannot be seen only as a tax-driven measure, and some very valid commercial reasons could lead investors to go through these shell entities. And this is actually reflected in the directive. We will discuss that a bit later. So that was for the background, knowing that a lot of other options were on the table for the European Commission for the implementation of ATAD 3. The first one, for example, was to first do nothing, which was basically not an option. Second was to use some soft law, just having some recommendations on substance, but nothing binding or enforceable. And then some other options were just implementing or imposing some minimum substance standards with or without the exchange of information and the application of penalties. So the solution taken by the Commission was actually to go through the full package, meaning minimum standard, exchange of information, and penalties. Now, regarding the question of whether or not this directive will be implemented as it is, that's another good question, because there's an open public consultation open until the 6th of April 2022. So until then, everybody can actually contribute to the improvement or modification or comments to this proposal of directive, because it's only a proposal right now. Once the consultation window is closed, this will have to be transmitted to the Council of the European Union for approval, following an opinion by the European Parliament. So we know that the agenda of the European Commission is to have this implementation by the 30th of June 2023, with a implementation and effective implementation actually on the 1st of January 2024. So we the answer to your very specific question would actually depend on how much the professional or the feedback given to the European Commission can actually influence the proposal, and there's a lot of open questions on this draft, and also on whether or not on how the member states will actually appreciate this draft and probably provide for some amendments.
Yeah, and to add to that, thanks, Jean-Baptiste. We've heard that, well, despite this directive being important for the EU Commission, it seems that Pillar 2 gets more traction than this one. And so we'll see whether it remains true. A lot of comments have been made by member states, including the big member states like France or Germany, about the wording of the directive that was, let's say that there was room for improvement. And so we can expect some amendments, or at least further discussions.
Thank you both. So at the end, what we have to when you read the ATAD 3 is again a kind of reporting, a kind of exchange of information. Olivier, what do you think? Is the new ATAD 3 proposal something which is in relation or a sequel to the EU DAX 6 directive? Because the DAX 6, as you know, is again a kind of reporting mechanism. What are basically the difference between the two, between the ATAD 3 proposal and the DAX 6 directive, in relation to this kind of automatic exchange of information?
Yeah, thanks, Juliano. Indeed, that's true. That's both directives. They rely on the automatic exchange of information. But that being said, the target different situation. DAX 6 is targeting aggressive tax planning, and UNSHAL is targeting the use of shell entities. So entities with no or minimal substance and with no real economic activities. So when it comes to tax avoidance, we can say that ATAD 1 and ATAD 2 were targeting tax avoidance, and ATAD 3 is a good nickname for UNSHAL, because also targeting a form of tax avoidance. Now, when it comes to the difference with DAX 6, there is a major difference, is that with UNSHAL, intermediaries are not anymore in the loop. DAX 6 relied on intermediaries to make DAX 6 reporting, whereas with UNSHAL, it's now the taxpayer that will have himself to find information in his tax returns. So as soon as the gateways are met, entities which are in scope, they will have to file a reporting on their level of tax substance, and this information, that will be exchanged between member states. DAX 6, UNSHAL as compared to DAX 6, the system is faster, because information with UNSHAL will have to be exchanged within 30 days, and the scope is broader. We see that in UNSHAL, for instance, the information exchanged there is information on the shareholders, on the UBOs, which was not the case on the DAX 6. And there is another very was an end in itself. The exchange of information was the goal of DAX 6, whereas with Anshell, the exchange of information is only a mean. It's only a step. It's only a step. It's an exchange of information ex ante, meaning even if the entity are not qualified shell entities, entities that are in scope will have to file information that will be exchanged with all member states. And finally, when it comes to the resemblance, so both texts are super technical. They are very technical. We recall DAX 6, they were the gateways. DAX 6, they were the hallmarks. They were the main benefit tests. And we are now with new technical terms, whose interpretation which will be very important. We also have a sort of look back in Anshell. Some gateways are assessed in the situation in the past 2 years, in the preceding 2 years. So a bit like DAX 6, there is a retrospective element in Anshell. And finally, to finalize on that, there is an element which is very important. So both texts are issued based on OECD work, as William was saying. And we can see that DAX 6 was very narrowly defined by BEPS Action 12. ATAD 2 was very narrowly defined by BEPS Action 2. And here we only have a directive which has some OECD base. It's based on BEPS Action 5, but there is really room because the text it seems it's only a EU initiative, so there should be room during the negotiation for the text to change because there is no hard base on that.
Thank you, Oliver. But at the end, it's still reporting. It's still automatic exchange of information. I believe we are really going to a very, very full, transparent world. So let's go more into the directive itself, and not just to detail every point, but in order to be included in the reporting mechanism, the directive foreseen a certain number of carve-outs, and there is one which is quite interesting. Is the undertaking withholding activity that are resident for tax purposes in the same member state as the undertaking shareholder or ultimate parent entity. If we read that, would you think or believe that holding companies or Luxembourg holding companies held by Luxembourg IEFs will be considered as resident of the same member state and hence really excluded, and so falling into this kind of carve-outs? What is your view, Danny, on that? So, because I think that's quite an important point taken into consideration if we see today most of the SPVs are held by Luxembourg AIFs. So.
Yeah, true, Giuliano. This is clearly the carve-out that attracts a lot of attention these days. There is also the gateway test, but that we'll discuss later. But this carve-out is really the one where all of us are focusing on. This is the one that is the closest to the fund and investment entity carve-out that exists in Pillar 2. The reference to ultimate parent or indirect shareholder seems to suggest that if you are a holding company, then you move up the chain up to a shareholder who either passed the test, meaning is not a shell company, or is excluded. However, it's true that the wording of that carve-out would require classification so that we are 100% certain of the interpretation. As you pointed out, Giuliano, the carve-out refers to undertakings with holding activities that are resident for tax purposes in the same member state as the parent, which seems to suggest that both the holding company and the parent needs to be tax resident. So meaning, what about a fund that is transparent, treated as that is an AIF, regulated but not resident. So that's an open point. I think that would be within the spirit of the carve out to say we exclude the funds because it's regulated, then we should be indifferent as to whether it's transparent or not. But that's clearly a point where a lot of attention is put on, and where clarifications will be required, because that would make sense to exclude if you have a parent entity that is a good entity, let's call it that way, not a shell entity, or that benefits from another carve out. It would seem natural to exclude the entities below to reduce the burden of the reporting, because at the end of the day, the objective is to make sure that you have at least one entity in the country and you have proper presence and substance to perform your activities.
And I think, Danny, we can say also that this is something that is matching in a way the position that certain countries already take today, in terms of looking at the substance in the country, which would be something which is natural by reference to how countries are defending themselves today in terms of access or abusive access of the directive, which in a way, in my view, is showing that already based on the elements that we have today, which is GAR, which is MLI, which are the Danish cases and so on, we need to have a certain type of coherence between the application of those and the view on the directive. But of course, the directive is coming with a different set of notions than those applied by a number of countries. So we can have, in a way, an unclear view from that perspective, whether the other countries would accept the defense in country or by reference to the latest entity in the chain.
Yeah, and I agree. And I think this directive should avoid being too prescriptive in terms of where to put substance. Taxpayers should remain free to organize their business and their affairs as they want. So if they want to put their substance in one entity or another, as long as it's in the country and they have everything to perform the functions and take decisions. I would say the legal arrangement that goes with it should be irrelevant for the purpose of that application. But this is the danger of that directive. I think EU Commission should avoid telling taxpayers or to organize their business affairs, and I think that's doable while achieving the objective of the directive.
Would it have not make more sense to have a kind of carve out like Pillar 2? You mentioned it, Danny, where Pillar 2 really foresee an exemption of the AIFs, including everything which is below. That would have made more sense. I don't know what's all your views on that, and if something like that could be then, when implemented, be included. Because that for me would make more sense. So because we cannot have one Pillar 2 directive, which clearly foresee that, and specifically ATAD 3, which has to carve out the funds, the AFM, etc., but not really the underlying companies below that AIF. So,
yeah, it seems that the wording here and the wording in Pillar 2 aim at achieving the same, but clearly not worded the same. So yeah, indeed, an alignment would be a great thing.
Thank you. So assuming that there is no carve out, and that we need to analyze whether the companies are or will fall into the reporting obligation. There are 3 cumulative gateways to be respected. So, and if we see the 3 gateways, at least 2 will always be respected. There is no way out, but there is one where I believe there needs to be more definition or clarification, but one of them is regarding the outsourcing of the day-to-day operation and decision-making on significant function. So, Alina, what should we understand with outsourcing of the day-to-day operation? And especially, who will certify that the day-to-day administration what function of the day-to-day operation are outsourced, and especially who is going to certify that the decision-making function are kept in-house and not outsourced, because that's really something which is very important, because if we can say that the decision-making significant function are outsourced, then what we can say is the company really managed in Luxembourg. So definitely, what are your views, Alina, on that? And really, who is going to certify?
Yes, Juliana, I think that these gateways is really extremely important, because as you mentioned, the first two gateways, which is more what type of income the company has, and international element, the cross-border element, will be very easily met by many of the entities just by the natural setup in Luxembourg. But this gateway is extremely important, and I have to say that today is the one that everybody is looking at in priority, because most of the entities will want to be able to show that they are not at risk of being treated of shell companies and to have to report. And this even if afterwards the companies can very well support their substance based on the second phase and the next set of criteria. But of course, today, the aim is going to be that you don't want to actually fail this criteria. However, this is also the part that I think we are all in the agreement, which is very unlikely in terms of terminology and the directive, and which in my view is emphasizing also another very big issue with the implementation of this directive, which is that the test is in a way, this test and the gateways is applicable already today because of the 2-year look back period which has been introduced. And so even if we are looking at the implementation of this directive 2024, because of the 2-year look back period, we are coming to actually, in a way, an application of this test today, but which is totally unclear. So which is, to me, is raising today issues of very big issues of legal certainty. How do we define this? What was intended by the legislator? I would like to point out first that this gateway provides a cumulative criteria. So a company needs to outsource both its day-to-day operation as well as the decision-making functions in order to fall into it. So it's not either or. However, the big question is, what do they mean? What does outsourcing mean? What does day-to-day operations mean? And also outsourcing of the decision-making functions. Of course, we can have long conversation as to what outsourcing means. Is it service just based on the service agreement? Is it, of course, everybody's wondering what's the influence of external directors in the idea of outsourcing of decision-making functions, although we all agree that when we appoint a a director on the company on the board is in a way no longer an outsourcing, it's a mandate. But today, there are unfortunately no sufficient elements to conclude what the legislative intention is and how far it goes in terms of what outsourcing means and the day-to-day operations. However, the important comment here, and this is a very natural link to what we discussed before, is that this gateway and this definition must absolutely be interpreted in light of the setups that are supported by an operational reality today. Notably, when we look in the industry, the outsourcing and especially internal outsourcing is largely used. And this is, for instance, towards an internal management company, towards an internal services company, or just pooled between master holdco structures. And all this, we need to know, is just the result of normal efficiency criteria. It is normal to put resources for internal efficiency rather than scatter them sometimes artificially between many entities. And this is, I would say, valid not for just our industry, but it's also valid for many industries and outside of any tax considerations. So I would say that in my view, the interpretation of this criteria in a very literal way, and which is not taking into account the economic and the industry context, in my view would actually have a very deterring effect, because we would be in that case asking, or this directive would be actually asking companies with a material amount of substance and functions in the country to artificially, in a way, split the substance and activities on multiple entities in a way which is first not efficient in terms of cost and operations, and would also require them to insource potentially activities and functions which don't necessarily make sense operationally. So this is why it's so important that outsourcing of day-to-day functions and of the decision-making functions is interpreted in a way which is matching the reality of the setups today, which are not necessarily tax-driven, which are operationally driven. So this is why it's important that internal outsourcing is being recognized. And then we have the conversation about outsourcing in the country. Again, it makes sense to pull the resources and to accept that the outsourcing, when it's internal, it's in the country. Then the other option, the other question is what outsourcing is concerned here. We are seeing that the preamble to the directive mentioned that, for instance, bookkeeping is not the one envisaged to be caught there, from where we could actually determine that maybe reporting and some just use of service provider for certain tax and legal and accounting aspects is not what is meant here. But this leaves us with the question, what else is there on the day-to-day operations? Also, let's not forget that outsourcing, whether internal or external, is always involving the supervision of the output and the responsibility of that output at the level of the board. So it's very unclear if you accept an outsourcing of accounting, of other legal services and some tax services. It's very questionable what else is there on the day-to-day operations. We could potentially think that what is envisaged is really full externalization packages. On the other hand, that is not the setup which is the most common in the industry. So of course we have a big question on the definition of outsourcing. And again, the outsourcing of day-to-day functions, day-to-day decision-making functions. Again, when a company appoints directors, external directors, they become part of the company in a way through the mandate. Is that outsourcing in that sense? A lot of questions in that respect, which are paramount for the players. But again, I emphasize the message that it really needs to be implemented in a way that respects the reality of internal outsourcing and also in the outsourcing in the same country.
I think this is quite important, Aline, especially the outsourcing of function, and the reason why is because even though the directive will be implemented in 2024, already structures put in place as of 1st January 2022 are in the scrutiny, meaning that they can already they can be into reporting activity or reporting obligation, and we will definitely not have any more guidance or clearance on this kind of outsourcing of function. What would you advise? So, but because there is already, we cannot stop implementing structure and waiting until there is more guidance or clarity or circulars on that. What is your view on that? So, or for all the panelists, what is then your views or advice?
From my perspective, clearly we are already, in a way, we already need to apply these very vague notions today. Then the question is, would you take 2 years, full years? You need to be compliant from day one, or it's an average, or is 1 out of 2 years? I think the questions are being raised out there. However, many of the setups that we see in practice if we have a normal interpretation of what outsourcing means in this respect, respecting the setups, you could say that actually it's aligned already. Of course, depends how harsh of a reading or how natural a reading of this definition is. But yes, I think it's a question how much, at least the identification for the companies to know how much outsourcing and contractual relationship they have in terms of the corporate governance. We definitely recommend companies to start looking from that first in order to identify how much the external print is.
And to add to what Aline has mentioned, and to your point, Giuliano, I think, yes, we should not stop implementing structures. Why? Because the structures have valid economic and purpose other than tax. Foreign tax authorities have not waited for that directive to ask and for information about the substance of the Lux codes, about and out of, I'm sure many of us have been exposed to audits from foreign authorities, and not all those audits have ended badly. So it means that the current setup and the current governance is in a way satisfactory, at least to certain authorities. And I would find very strange that all of a sudden, because of the wording of the directive, then those entities end up being shell and not receiving a tax residency certificate.
Indeed, and then I would share those visions as well. And I just want to point out that actually the filing of the tax return is going to become a strategic moment. And that, of course, the definition of outsourcing needs to be monitored on the next 2 years. It's really a headspot point.
Thank you. Thank you. So assuming now that the gateways to trees are respected, so the ATAD tree then foresees or relies on indicators of minimum economic substance for tax purposes. So what are, Oliver, for you, these new indicators of economic substance? Do you believe that they are aligned with the current economic substance standards and market practice? Again, who will certify that those minimum substance requirements are met? And especially all the indicators concerning the directors and employees of these companies.
Yeah, so indeed, when all the gateway criteria are met, then there would be reporting obligations in the tax return. However, probably just to make a point on the gateway criteria, given that are cumulative criteria, I believe that a key or of utmost importance is really like a decision making on significant functions which normally should not be outsourced. And the decisions are taken by the directors, and the board of directors takes all the important decisions of the company and should be considered as own resources and not outsourcing. But if we were to conclude that all these gateway criteria are met, then we would have reporting obligations, and the so-called indicators of minimum substance are rather surprising. So the first one would be that the entity need to have own premises in the residence state or premises for exclusive use. So that would suggest that the entity acquires an office, which is rather uncommon, or has an office for exclusive use. I mean, if we look at, say, like EU law as interpreted by the Court of Justice of the European Union, here we have like case law that there is no need for having premises for exclusive use. Instead, an entity may have premises available when needed. So it could be then rented ad hoc, or it could be premises that are rented or owned by another group company in the same jurisdiction. So therefore, this first indicator is not really an indicator of like minimum substance as required by EU law. Then the second requirement would be the entity need to have an own and active bank account in the European Union. So I would assume that most, if not all, entities have a bank account in the Union. And now the question is, what does it mean, or what do they mean with active bank account? Here, I would assume that the bank account need to be operational and should be used when needed. It should not mean, however, that each and every time, say like cash need to be routed through the bank account of the entity when, for example, we implement an investment. And so like we have like, say like 3 entities in a chain of entities, and so we do not need to route the funds through the account of each and every entity, which would make it fairly uncomfortable to implement investments because of the time the cash is on the way. And then the last criterion concerns either directors or employees, so there are 2 alternative indicators. So the as regards the directors, so there should be 1 or more directors that are resident for tax purposes in the residence state of the entity, or live in proximity to the residence state of the entity, so that they could commute. they should be qualified and authorized to take decisions. And they should actively and independently use the authorization to take decisions on a regular basis. So far, so good. I mean, this is something that we would always recommend, any taxpayer, to have like local one or more local directors on the board of appointed to the board of directors that are qualified and that are also properly involved in the decision making and not just rubber stamping any decision. Now, the last element as regards directors is a bit more concerning, because here the requirement would be that such director should not be an employee of an enterprise that is not an associated enterprise and should not perform the function of director or equivalent for other enterprises that are not associated enterprises. So that would target the kind of independent directors which are perceived by many as a best practice situation, or directors that are employees of a corporate service provider. Now, we should not forget that directors have a significant personal liability if they are employed by a corporate service provider or if they are an independent director. So that means a director will always fulfill the role of a director independently and take say like a proper due diligence for each and every decision, because if things go wrong, and as banal as filing the accounts late can result in the personal liability of the director. But I mean, obviously this criterion here, many entities will not meet that. So therefore, it's very important to properly interpret the gateway criteria, because I mean, if the gateway criteria are not met, you do not have any reporting obligations and you do not think about these indicators. And then the alternative criterion would be that the majority of the full-time equivalent employees should be resident member state or live at close proximity so that they could commute, and these employees should be qualified for their activities. Now, this would assume that the entity itself should employ staff. This is also not always the case, because I mean, typically you have the substance being bundled at the level of one entity or few entities, and then the other entities would rely on that substance. So that means this third indicator of minimum substance would be very problematic for any entity where the conclusion would be that the gateway criteria are met. And yeah, then the question is like, yeah, who certifies that? And I think that's already a question like for the entire ATAD 3 analysis, because I would assume that say like directors will require a comprehensive tax analysis to be performed by each and every for each and every entity, so that they feel comfortable either not to report because the conclusion is that the gateway criteria are not met, or to report in a certain way on the indicators and so on and so forth. So because otherwise and we didn't speak about that, like the directive in case of non-compliance goes with severe penalties that have like normal significant penalties that need to be decided on by the different member states. But on top of that, we have a 5% of the turnover punitive penalty on top. So every director will be very nervous about getting this right. Yeah, and then on top of that, I mean, apart from reporting on these minimum or on these indicators of minimum substance, taxpayers would also need to file significant documentary evidence that goes quite far. And then the question is like, if the entity fulfills all the indicators of minimum substance and provides documentary evidence, then there would be a presumption that the entity is not a shell entity and meets minimum substance. In contrast, if one of these criteria is not met, or the entity fails to provide comprehensive documentary evidence, then there would be a presumption that the entity is a shell entity, which is not the end of the analysis, because then that is just like a rebootable presumption. So it means like then on a case-by-case basis, one could still perform an analysis and evidence that the entity is not a shell entity. However, the problem with that is, and normally, I mean, today, investments that are implemented should always adhere to, say, like, or respect minimum substance And here we have, like in an EU context, the wholly artificial arrangement doctrine. So that means like each and every entity should in principle be able to reboot the presumption. However, the problem here is also from a practical perspective and a timing perspective. If you then perform this analysis and then you submit it to the Luxembourg tax authorities, how long will it take to make an assessment on this? Apart from then on top of that, there would be additional reporting obligations when the Luxembourg tax authorities would conclude that the entity is not a shell entity, then they would need also to provide or to exchange information on why they took the decision not to conclude that it's a shell entity. So does that answer the question, Giuliano?
Definitely, and I agree one point with you. Definitely, we need to the gateways, the 3 gateways, to avoid to be falling under the reporting. It's very crucial because I do not believe that everyone wants to go to this kind of minimum substance indicators or through that. Anne-Cécile, what's the perception of the market regarding this directive, and especially the actors that are active in the domiciliation? What's your point? What's your view on that?
Thank you, Giuliano, for this question. I would like to say that even if we described it at the beginning, the differences between DAC6 and ATAD 3, the service providers are again in the crosshairs of the European Commission. And definitely, we need some clarifications in different aspects described in this directive, because we are on the operational side. And the more guidance we receive, the less time we will spend on processes, implementing the directive, and also the less the costs we will incur. So we would like definitely have more guidance compared to what happened with the DAC6. And also, yes, the definition and the interpretation of outsourcing and the cumulative criteria for us is key, is a key element. And based on the structuring that we have for the fund industry, we can see that we interact with different parties, but definitely the entities we administer, we do not have the feeling that there is an outsourcing of the key elements, the key functions. So this is something maybe that we have to explain, and we hope that we will have some amendments maybe in the directive or in the Luxembourg law, because we definitely think that we are not in the scope. But what I would like to highlight is what we are doing as service provider. You know, all the services we carry out, like administration or domiciliation, is legal. We are all the services are described and in laws or CSSF circulars. So everything since the beginning, from the setup of an entity or during the life of the entities that we administer, everything is legal and very well regulated. We can't domicile or administer any entities that do not respect the current substance rules that we have in Luxembourg, or we cannot use some entities that for tax avoidance or tax evasion, because us, you can imagine, if we are not compliant, we have a sanction here in Luxembourg, is we can lose our license and we can close our business. So this is something that we would like to emphasize also, that our activity is completely authorized in Luxembourg, and we just need some additional guidance in order to help the assessment for our clients regarding the third gateway. And also, definitely, we would like our clients not to report anything.
Thank you, Anne-Cécile, for your view on that. There is one article in the directive which has surprised me, it's regarding, assuming that Luxembourg will say, or one of the member states will say, we consider that this company is not a shell company. So for us, it is fine. It has either the 3 gateways or it has a minimum substance, etc. But there is still an article in the directive that the foreign member states can request, even though it is not a shell entity, a tax audit on that entity. So there is, for me, a point of where the harmonization between EU member states can be challenged. Again, there will be, for me, uncertainty at the EU level. Jean-Baptiste, how do you see the specific article in the directive? Will the kind of holding jurisdictions be more under scrutiny, even though member states where they are located consider them as not a shell entity?
Yeah, thank you, Giuliano. Indeed, the directive is mainly twofold. One is the member state of the jurisdiction where the entity is implemented will have to check whether or not an entity is at risk and whether or not it complies with the minimum substance indicators and whether or not it can rebut the presumption. So, for example, for Luxembourg company, that would be an assessment made by the Luxembourg tax authorities based on information provided by the company and also information provided in the tax returns. And as discussed before, we already know that there are some uncertainties and some concept, even though at first the directive seems to have a kind of objective nature. So if you look at the gateways, we have 75%, 60%, so just the numbers given, and then there's a question for uncertainty, then for the significant functions as described by Alina, the question of the qualification independence. So then you can see that there are some uncertainties on the definition, but there is also this subjective approach on the rebuttal of the presumption, where the company can show that it is, although it has as low substance, it can justify that it has the setup is actually made for valid commercial reasons, and that the company has maintained a high degree of involvement in the normal business activity, and it has also been able to perform control over the risk of the entity. So this is a pure, for example, that would be a pure Luxembourg approach. But then, as you said, even if you can demonstrate that the company is in line with the objective of the directive and has enough substance, there's this procedure provided by Article 15 of the directive, saying that another member state can actually request a tax audit to the tax authorities of the country where the entity is located, which actually means that you would ask that tax authorities to redo the assessment or read the check that was probably done in the first place. So the question is whether or not this, once the audit is conducted and the tax authorities or the relevant tax authorities have released their outcome, whether or not the requesting member state can challenge this outcome and actually deny the benefits of the directive, because the Article 15 has to be read in conjunction with Article 11, which provides for the tax consequences of not being in line with the objectives of the directive, meaning, for example, not having access to the benefits of the EU directives on interest and royalties or the parent subsidiary directive. So, as an example, let's imagine you have a holding company in Luxembourg which is supposed to receive income from a Danish entity. Then the Danish tax authorities could actually ask the tax authorities in Luxembourg to conduct the tax audits in order for them to provide for an exemption of withholding tax, for example. So within a month, the audit has to be initiated. So it's not indicated how long that should be, but you have to start the audit within a month. And then, of course, the Luxembourg tax authorities will continue to rely on their own approach. But as we said before, because there are some uncertainties on the concept and some subjective approach, it may be that the way we see the situation from Luxembourg perspective might not reflect the requirements of the Danish tax authorities. So the directive doesn't seem to give right now the legal ground for a challenge of this outcome of this tax audit, but it also could be possible that this would be used by the Danish tax authorities, just as an example again, to challenge some other features of the Danish tax law, but not exactly on the ground of the directive. So indeed, that it will be important for us to, in the next few years, to have also an understanding of the non-Luxembourg concept and how the foreign tax authorities understand this concept, to make sure that we can grant our clients some security and comfort on the application of this directive.
Just to complement quickly on this one, even if it's very difficult to predict what will happen, such a text involving an audit on request of foreign member states, we don't know yet if it will be used, especially at the beginning, simply because it might be simpler for a foreign tax authority to simply seek real shell entities and not use a text which is likely to raise exchanges between member states. And it's likely that there will be this hurdle that the DAC framework will apply. So we could expect that the tax authorities will want to choose their battles, and they might not want to use immediately these provisions.
Thank you. What concerns me is what is the perception of this directive, or draft directive, either from an EU or a non-EU country. So the purpose is, will there be a loss of competitiveness? And will there be a directive that will be extended to third countries? So what's your views all on that?
Well, we know because it has been announced that an unshell directive or ATAD 4, depending on how you call it, is being worked on with respect to third countries. So I think Europe is very conscious that if they only issue an ATAD 3, it's putting Europe at a competitive disadvantage compared to third countries, and Europe has acknowledged the necessity of foreign direct investment. So it's important. Perception of other countries, we are still collecting that. Alina mentioned that some countries already look at the substance in the country, others look at the substance in a given entity. From the few discussions we've had with colleagues in the network, it seems that foreign authorities have not waited for that directive to raise question or to challenge in order to benefit or in order to grant access to directives and treaty. Oliver mentioned the substance criteria. Seems to me that at least 2 of them are a bit outdated. Who knows whether companies will use bank accounts in the form that we know in a couple of years, and office space at a time where we discuss co-working, home working, and all of that. So it's a bit the perception, like the EU and the countries have many tools to challenge. They have tools to challenge the purpose, tools to challenge the beneficial ownership. If we look at the substance criteria or substance indicators that have been created for the purpose of IP activities as a result of BEPS Action 5, they were more looking at activities and functions more than as what is the legal setup in the country. And I think it would make sense here to have the same approach rather than looking at such indicators like they did in the Netherlands with their 100K employee costs, a criteria or an indicator coming out of nowhere. So they are just proxies for substance. They are not real substance indicators. So.
And probably also looking not just at the perception of other countries, but also on the part of the taxpayer. So I think the draft directly definitely raised the attention of the taxpayers. And the very fact that the directive is out creates some legal uncertainty, which is never positive. However, with regard to the tax consequence, because the directive on the one hand, or the proposed regime on the one hand would result in reporting. On the other hand, if there is an entity that is identified as a shell entity, there would be tax consequences. But here one can say, like, if an entity would have an issue in 2024, because this proposed regime would be implemented, it would already have an issue today because any tax benefit could be challenged based on existing anti-abuse legislation. Also, one must say that substance has been high on the agenda of investors and asset managers, and so like investors and asset managers have been responding to the requirements provided under ATAD 1, ATAD 2 and DAC 6 and all the tax law changes that followed. So it means when we speak about investments within Europe, you always need to have a European investment platform, and here I believe that Luxembourg will remain the jurisdiction of choice. Now, if we look more general, like to the European Union, and if you think about the competitiveness of the European Union, and here I think it cannot be positive to add layer and layer of complexity and regulation that does not add anything, because in a way we need to look at each transaction that is implemented already under DAC 6. And now this year is just like an additional layer of complexity where whenever we implement an entity, we need to analyze the substance of the entity, while this is already somehow included in the main benefit test of the DAC 6 regime.
Thank you all. I know we are running out of time, but there's just wanted to understand of all of you, if you anticipate that the ATAD 3 proposal will change your daily practice. So how do you see this proposal? Will that impact your advice on providing on tax planning and deal structuring? How is your views on that?
I'd say, like, in my views, that will not change a lot, because already today, and as I mentioned before, existing anti-abuse legislation could already be applied if an entity doesn't have an appropriate substance. So I think what will happen is that now we need, whenever we implement an entity, we need to perform an ATAD 3 analysis, and hopefully there might be some synergies with the DAC 6 analysis, so that the cost or the extra cost will not be too high.
Yeah, I fully relate to that as well, because when we look, it's even some of the criteria, it is just mentioned, bank accounts, offices, is something that was already out there since many years. So it's really nothing new what comes with it. However, I think that where things may have relevance is in the documentation, and the ability to act fast is more on the procedural part, and the reporting. Even if you're not in the reporting, is the possibility to access and have everything ready to obtain the tax residency certificate, because we all know that that is going to be one major point for taxpayers to be able to access the tax residency certificates in real time of the transactions. And that would maybe require, in terms of documentation, readiness of information, reporting, we'll need to see how it is, but that's maybe on the compliance side that things will just need to move faster in certain circumstances.
Yeah, and same for lawyers, for the practice of lawyers focusing in tax. It's been more than a decade that we are advising on the economic substance side. The criteria of economic substance, they have not changed. So our practice will simply evolve. Also, with Unshell, what we have to do is that the directive is very technical, as mentioned. So we will have to advise our client whether they can get out of the gateway, whether they need to find exemption for tax motive. So we will need to help them to navigate the risks that are in the Unshell directive. There will be a role which will be also to intermediate with the tax authorities to reclaim this or that exemption, and to be aware of the level of information that will have to be given. So likely lawyers specialized in tax and tax advisors in general will have to represent their clients in front of the tax authorities. And then you have indeed this part where it's expected that there could be audits. So tax advisors will have to have a deep level of knowledge of the ECJ case law and of procedure, yes.
from the service provider side, we have the feeling that we will have more a coordination rule, and we will work more with the tax advisors and the clients to help them, because the tax residency certificates, it's key for our clients, and we have to answer very quickly. So this is how we see our role.
So thank you all for your contribution. So I think we are really running out of time. It's already over. There are some questions. What I would suggest is as we are running out of time, I take only one question, and the others, please don't hesitate to reach out to all the panelists. They are more than happy to answer your questions. So the one question which has been raised is, do you think that the Luxembourg tax authorities may want to deviate from its usual policy of self-tax assessment as a result of ATAD 3, and also be more strict on the filing deadline? Who wants to give an answer on that?
I can start. I think they may want to do it. Now the question is, will they have the resources and the capacity to handle all the returns? And as I think it's Oliver or Alina who mentioned, will they have the time and resource to analyze every single entity, whether it benefits from a carve out or not, whether it has the substance criteria, what about the rebuttal request, etc. So yeah, it's more a practical consideration than a willingness. Yeah, they might want, and they may be tempted to do it, but the question is, given the broad wording of the directive, it's huge amount of work from them, and it raised the question then of proportionality of the text of the directive and the objective they want to achieve.
Yeah, agreed. Indeed, this really the question of resources, and I guess indeed they would be happy to stop the self-assessment and be able to go into much detail into the tax returns, but also with the fact that they will have to answer to tax audit questions, which will also increase the workload. It's hard to believe that they will be able to deviate from this policy, because, as you said, Danny, it's more a question of means and resources.
I think, yeah, Alina, please go.
No, go ahead. No, I think we also have a question of the entities which are not in scope. So I think that changing a policy which is global for now into something that applies just for companies which are in scope, this would raise also certain questions. Let's not forget there are many companies out there which are also not in scope of ATAD 3 at all or partially and so on. So, but this is raising absolutely the question, how are we going to file based on what criteria and how fast is going to be assessed. I'm a bit maybe less convinced about the change, even if would be positive also for some other cases.
And I was just going to mention on the date of filing of the tax return, I would expect that the tax authorities will try to be clearer on the exact time when the filing will be necessary. And so on that specific point, on the filing of the tax returns, we can expect that the tax authorities will be stricter than they used to be.
So really, yeah. No, go ahead, Danny. Go ahead.
No, go ahead. It's already a trend. We already see the tax authorities asking for and being a bit more strict with respect to filing returns. So, yeah.
So I know it's quite an important topic. There will be definitely a follow-up on that, especially when we have more clarity how the directive will be implemented. I really want to thank the audience for having attended this ATAD 3 webinar, and more especially, I really want to thank all the panelists really for their contribution and the highlights, and let's see the next steps on the ATAD 3. I want to thank you really everyone.
Thank you, Giuliano, as well.
Thank you.
Thank you, Giuliano.
Thank you.
Thanks, Giuliano.
Thank
and
you.
Also the LPA team wanted to thank you for this excellent delivery. This was really robust thought leadership with, let's say, your views with concrete examples. So let's carry on. I mean, more technical webinars to come over the next weeks, and we will also be on the road again from this week on. And don't miss out the RP Academy starting tomorrow with the DC Foundation course and module, and certainly also our job fair for the talents to be attracted to Luxembourg, which will be held on March 17th. So stay tuned, see you soon, and thanks a lot.
Thanks everyone.
Bye.
Thanks.
Bye.
Thank you. Bye.
Bye.